Hello, this is Japanese Economic Review Channel. Today, we review the Cabinet Office's second preliminary estimates for Japan's Q1 2026 GDP. We will explore growth drivers, demand shifts, and the critical statistical revisions that provide a truer picture of our macroeconomic landscape. Starting with the headlines, Q1 real GDP grew by 0.5% quarter-on-quarter, or a 1.8% annualized rate. Nominal GDP increased by 0.6%. While these figures confirm consecutive growth, the momentum indicates a stabilizing, rather than surging, economy. A key takeaway is the downward revision from the first preliminary estimates. Annualized real growth dropped from 2.1% to 1.8%. This was heavily driven by a stark revision in corporate capex, which plummeted from a 0.3% gain to a 0.7% contraction. Comparing nominal and real growth highlights an interesting divergence. While real GDP remained resilient at plus 0.5%, nominal estimates faced sharper downward revisions. This reflects a weaker-than-expected domestic demand deflator environment. What drove this Q1 growth? The answer lies outside the private sector. Net exports provided a robust plus 0.3 percentage point contribution. Simultaneously, public demand added another plus 0.1 points, stepping in to support the broader economy. Within the private sector, we see a stalemate. Household consumption held steady, contributing plus 0.2 points. However, this was entirely offset by a corporate retreat, with capex and private inventories each dragging growth down by 0.1 points. Looking at consumer behavior, there's a clear pivot. A sharp 3.7% quarterly contraction in durable goods was fully offset by a 1.2% rebound in semi-durables and consistent 0.2% growth in services, showing targeted household resilience. The corporate sector presents concerns. The revised minus 0.7% drop in capex alters our initial optimism. Furthermore, massive destocking of finished goods and work-in-progress inventories, totaling over 1.6 trillion yen, held back aggregate growth. As private demand stalled, external and public sectors provided a crucial floor. Exports surged 1.8%. Domestically, government consumption rose by 0.3%, and public investment spiked an impressive 1.5%, keeping the Q1 economy in positive territory. Shifting to the fiscal year, FY 2025 real GDP capped at a modest 0.8% growth. Interestingly, despite Q1's weakness, private demand was the structural anchor for the year, growing by 1.0%. This highlights underlying domestic resilience. Breaking down FY 2025, private demand was the dominant growth driver, contributing plus 0.8 points overall. Meanwhile, net exports, which saved Q1, actually acted as a drag over the full fiscal year, stripping 0.1 points from annual growth. Why the massive Q1 revision? We swapped early supply-side extrapolations for hard corporate data from the Ministry of Finance. This revealed a vast disconnect, triggering complex integration adjustments that exposed a weaker demand-side reality. This hard data integration also shifted inventory calculations. By replacing predictive ARIMA models with actual corporate financial data for raw materials and work in progress, we uncovered significant destocking, locking in the GDP drag. To ensure statistical clarity, the Cabinet Office utilizes rigorous seasonal adjustments. By applying additive outlier dummy variables when data breaches a 99% confidence interval, we prevent pandemic aftershocks from distorting the baseline trend. Looking ahead, the first preliminary estimates for Q2 2026 will be released on August 17th. We will closely monitor whether the corporate sector recovers or if the economy remains reliant on external support. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.